We're talking about earnings season. We're kind of really shifting the conversation from tariffs. The markets don't seem to be reacting that much to the tariffs. Evercore ISI out with a note saying that tariff developments increase odds of a sell-off. Obviously, we're not seeing that right now. Markets turn positive. But they go on to say likely result in further EPS estimate reductions, even as investors are sanguine about the potential EPS estimate cuts. The inverse correlation of the trade uncertain and the S&P 500 increases the odds of a near-term pause in the stock's rally. Do you see a setup like this one, or do you think the tariff threat and fear may be overblown and people are really looking ahead? They're looking ahead to earnings.
I think with the exception of the first announcement of tariffs on Liberation or Independence Day, whatever it was, Liberation Day, the markets ignored it. The markets ignoring every risk. They're ignoring the risk with the Fed. I mean, you've got somebody in the White House who's a real estate investor. They live on debt. So you've got that. You've got, normally, you'd see a major upheaval in the bond market. Because rates would just go through the roof with instability there. If you listen to Kevin Haslett today, and I think he's a smart guy, he's got zero credibility for what he says, that tariffs aren't going to impact the buyer, meaning the consumer, or companies. I can tell you in the supply chain, as we look at it in some of our companies, aluminum's up 50%, so sourced from the U.S. The U.S., the companies here are not fools. They now see a pricing umbrella 50% above where they were. So where are they? They raised their prices 35%. So even if you don't pay the tariffs, you're going to pay it here. And look, companies that have EBITDA margins, like grocery stores, like many others, the auto companies, they're mid-single digits at best. They can't absorb the tariffs to operate a loss. So we'll come through. So the question is, back to Trump, he said there are deals. There are no deals. There are letters that he's saying this will be our deal. But deal takes two parties. So he's going to have to renegotiate. The question that you bring up, at some point, he's not going to tackle it. At some point, he's got to say, we're doing this, not just with steel and aluminum, but more broadly, so every other country feels it. The critical countries are, of course, India and the EU and Japan. Once you get through those, then the others really don't matter. So I think you've got to see some deals or some maybe fake deals like we did with the UK, where it really doesn't matter. In terms of the market, overall risk in the market, it's definitely the Fed, right? You can't put a complete dove in there. It's definitely tariffs. It's also inflation that could come from the spending bill that was just passed. And then it's more cuts they're talking about. So I think that the market's going to continue to ignore these risks, as they have for the last year. And the market steps okay. And just the final word in earnings, it would be an extremely disappointing earnings season, if more than 75% of the companies don't exceed expectations, because that's what they always do broadly, both on the revenue line and on the earnings line.
But is that what you think is going to happen? You're saying you expect that to happen?
Yeah, I do. Okay. I do.
So I feel like the three of you are pretty optimistic about this earnings season.
I didn't say that. I didn't say that.
Well, I mean,
I don't think that the
which have been lowered in all fairness.
I think you have to have a strong awareness of what's going to happen this earnings season. The potential for margin compression to occur is real. And I think if you're looking for some form of a near-term catalyst that's going to shake the bullish momentum, I think it's coming from earnings. It's not coming from the announcement of these particular tariff rates.
It will come if the tariffs do stick, if he doesn't back off. So if August 1 comes, and all those tariffs get implemented.
You mentioned that the EU and, in your mind, India are the two important ones. Well, the EU one's hanging in the balance right now. The EU said they want to work with the president, but they've also said previously that some of the terms seemed a bit unreasonable, and that's why this has been extended.
Right. So my point is that everybody said we want to work with the president. India said it. Japan said it. Japan said we'll have a deal by June, July. Where are we?
Well, in all fairness, some people say they want to work with the president, but have also spoken out saying it's unfair. China is a great example, and obviously
China's
a huge situation there when it comes to trade. I don't want to leave Jim out. Jim, I want to come over to you. You
never leave Jimmy out.
Yeah, we were talking before the show, so please let me know if I'm mischaracterizing, but you're not quite optimistic about earnings season. You're actually taking a little bit of money off the table, Oracle in particular. Oracle up over 30% year to date. What's the rationale going into earnings season, and also the idea that we have July seasonality, where July is one of the best months of the year?
Yeah, so let me just simplify my message. I'm picking stocks, okay? I see, this was a great discussion. Risks, opportunity, I see them fairly balanced. I look at a market overall, the S&P 500, that trades at 21 times next year's estimates. Maybe those estimates will be hit, maybe they won't. But I don't mind in that environment taking just a little bit of money off the table. And for everybody watching, I want to make this clear. I'm not negative, okay? Don't look at it that way. What I'm trying to do is I'm saying some of these stocks, first off, remember, I've been fully invested since the beginning of the year. So this is a gangbusters year for me so far. I'm taking some money off of the table in my winners. Oracle was last week. Frank, you'll be on tomorrow. I'm most likely to have another one tomorrow. Just raising a little bit of a war chest, because what I think will happen this earnings season, I do think overall we're likely to exceed a very lowered bar. But what I'm really looking for is what always happens in earnings season. One or two stocks actually have good reports, and the markets, for whatever capricious reason, just decide to sell the heck out of them. And I want to have some dry powder available for when that happens. If it turns out that I'm wrong on that and the market keeps going higher, I'm not going to build so big of a war chest that it's going to hurt me as the market goes higher. But I do want to point out, seasonality usually does occur August, September. And it's frankly because of people doing exactly what I'm doing, saying, listen, we've come a long way in a short period of time. It's August. I want to put my feet up. I'm actually going to take a little time off later this week. I want to put my feet up and not worry about things so much. I'm still going to be plenty invested, okay? The market goes down, I'm going to feel it, but I'm going to have the dry powder with which to pounce.
All right, so with all that said, if you guys don't mind, Lisa Shallot from Morgan Stanley Wealth out with a new note. I just want to, it's a little bit long. I want to run it by you guys and see if you agree, disagree with this thesis. She says in part, her and her team, we see the S&P 500 gains beyond the 6,500 to 6,600 range as difficult to achieve. Some investors still envision risk around inflation and policy restraint. We're also unconvinced the dollar weakness is purely benign given the amplification of tariff impacts. Furthermore, we're skeptical that tax code changes, net of some pay-fors, are stimulative enough to prompt a new investment boom. And then they go on to say something you guys were talking about. Operating margin gains may also be elusive as accounting mechanics, demand destruction, tariff absorption, and commodity gains toward upside earnings surprises. So quite a bit to digest there, Shannon. I just saw you kind of raise your hand there.
Yeah.
A lot in there. I'm going to be in all fairness, a lot in there.
I want to focus on the very last part, that the tax opportunity is not enough to stimulate a boom. What I would counter, and I have a lot of respect for Lisa, what I would counter is that if it would not be, if we were in a situation over the last number of years where there had been significant investment, capital expenditure, and we had not been in a very difficult regulatory environment. So I think that there are multiple tailwinds that, while the tax changes alone are perhaps not enough to catalyze this investment boom, I think coupled with deregulation, lower interest rates, which are coming. I'm not going to, we don't spend a lot of time on that. And also the likelihood that companies have been waiting. Investors have not been asking companies to grow in this past period. They've been allowing them to hunker down and protect, to Joe's point, their margin. That is going to shift. And so if that, to me, is one of several forces that are likely to drive this boom, which is why we think that there will be an acceleration of growth into 2026.
You know, in all fairness, I was just talking to a pretty big transport CEO, exposure to a lot of different industries. They said the one big beautiful bill passing, yes, that's a tailwind, and companies want to invest. But at the same time, if there's any more tariff disruptions, they may start to pause again. So concerned that while a lot of people think that this tariff won't happen on August 1st.
They are paused. They're not going to pause again. They're all paused. Like, there isn't this massive, M&A activity.
Does the one big beautiful bill start it, or is it still paused until more clarity?
No, I think you need to have more clarity, but I think it's one of several catalysts. I mean, tariffs are going to be with us through the end of the year, the bottom line. And so at some point, though, investors are going to catalyze investment to these companies because they're going to be looking for you not to sit on your hands anymore.
What was in there to drive CapEx, there's small levels of CapEx. It's not like you're building a new plant. They're basically for
equipment. Isn't that the point of the tariffs, to build new plants?
No, you can do it's resident.
How long do you think it takes to put up a
3 to 5 years to build a new plant?
Software.
But isn't that what this bill's supposed to do?
Years or
to
so.
Start the process?
Well, for building plants, yes, and they're expanding it. But the point is to drive additional growth. You're not going to see that. The major CapEx spending is still on pause. We've yet to speak to a CEO where there's clarity. And that even includes where it's not, major CapEx spending, like a healthcare insurance company. They don't know where the FDA is, so everything's difficult. They don't know where Medicaid cuts are going.